Imagine waking up to a headline that sends oil futures surging by 10% in seconds, and your portfolio hanging in the balance. Today, we unpack what the coordinated U.S. Israel strike on Iran really means for your money. Breaking news: after 43 years of restraint, the U.S. has joined Israeli forces in a precise strike on Iran's top 3 nuclear facilities. Deep condolences to every life lost. This video is strictly informational and not financial advice. Always consult your advisor before making moves. Let's cut through the noise. Here's what we know so far. Targeted were Iran's premier nuclear research sites, facilities said to house centrifuges enriching uranium. These strikes come on the heels of escalating drone exchanges and diplomatic brinksmanship. How will markets open? Will crude oil spike past $120, $150? And what about equities from New York to Shanghai? History shows us that geopolitics sparks knee-jerk reactions. During the Gulf War, the S&P fell about 10% but rebounded 25% within a year. The dot-com crash and 9/11 drove wild swings, but the long-term uptrend held. And even the Soleimani strike in 2020 prompted a brief sell-off before markets shrugged it off. Panic is a poor strategy. Let's replace emotion with data. 4 steps to navigate this shockwave. First, breathe and don't rush. Selling into fear locks in losses. Second, audit your oil-sensitive holdings. Airlines, logistics, consumer discretionary often suffer when crude heads north. Third, lean into defensive sectors such as healthcare, utilities, and dividend stalwarts. Fourth, revisit each company's competitive moat within your circle of competence. Markets will be glued to 3 signals: any sign of a ceasefire or wider coalition, potential retaliatory strikes, and central bank moves as they weigh inflation fears against growth concerns. If tensions ease, this could be a brief wobble. If they spiral, expect higher volatility. Meet Sarah, a teacher from Dallas. In 1991, she invested $5,000 in an S&P index just days before the Gulf War began. The market dipped 8% in a week. She panicked, almost sold. But she held on. 12 months later, her investment soared 30%. Today, she still lives by that philosophy: time in market beats timing the market. Safe haven checklist: gold remains a traditional hedge, but avoid chasing peaks. Cash offers flexibility, though inflation erodes purchasing power. ETFs and index funds provide low-cost, diversified exposure. Consider inflation hedge or commodity tracking funds. Balance, not panic, is the goal. One overlooked twist: if oil holds above $100, we could see inflation research, deterring the Fed from cutting rates, or even pushing them higher. Remember, the Fed chases lagging data. A sustained oil shock may change their whole playbook. For short-term traders, tighten stop losses, hedge with options, or pivot to inverse oil ETFs. Long-term investors should stay the course, dollar cost average, and use volatility to scoop up high-quality assets at discounts. Generational opportunities often hide behind fear. Volatility isn't a bug, it's a feature of markets. It rewards the prepared, not the panicked. So stay informed, stay rational, and stay the course. If oil actually hits $150, what's your plan? Let us know in the comments. Let's take a moment to hope for peace, and for wisdom as we invest through these turbulent times. As Sir John Templeton said, the time of maximum pessimism is the best time to buy. History is our guide, strategy is our compass.